what we're going to be looking at here is acquisition or construction costs of property, plant, and equipment. And what we're going to be specifically looking at here is our land and our buildings here. And how what would be included in our accounts here when we're getting these land and buildings ready for use here. And what we have to do is we have to bring it to the location and the condition necessary for its intended use. And what we're going to be looking at here is during the construction period. And our specific problem is going to be where we have purchased some land here with an old building on it, and then what we have to do is we have to remove the old building here to put up a new building, and we want to look at how we'd account for the costs involved here. But before we get into that, let's go and look at what would be included in our specific accounts here when we're acquiring land and buildings here for putting them into usage here. So first off, for our land here, and again, what would be included here is to get the land ready for use, and land has an indefinite, these are the items that have an indefinite life here, and that's what land is considered here. And we really don't depreciate it, but it could be written down later if it decreases in value here by a great amount. But number one here, we have the purchase price, that's the amount paid here. We have closing costs here. I'll just scan through. There's your title search, professional fees, attorney's fees, recording fees here, and then encumbrances on the property, like assumed taxes, attached liens, assumed mortgages, assumed other liabilities, and assumed property taxes. And number four here, the cost to get the land ready for use, the removal of old buildings, demolition less its salvage value here. And this is what we're going to be looking at in our example here. And then other costs here would be our grading, filling, draining, and clearing. And then five here, we'd any additional improvements which have indefinite life here again. And then six here, special assessments or local improvements such as pavements, that would be the roads or highways in front of it, street lights, sewers, drainage, and they have indefinite life here because they're maintained by the local government here. Now let's go up here, and we have one other account here where we have we would classify these here as land improvements. They're not included in the land account here, but they're classified here as land improvements here. And this is again getting the land ready for use, and these would have limited life here, and those would be like installing fences, parking lots, private sidewalks, landscaping, and so forth. And now let's go look at our building account here. What would be included in the building here? That's what is constructed on top of the land here. And getting the building ready here for use, that could also be self-constructed buildings here. You would take the purchase price here if it's purchased here, and if it's made or built here by your self-constructed here, you'd have your material, your direct labor here, your overhead, and then you'd have any repair charges, alterations, and building excavations. That's for digging holes to build a building here. Professional fees, permits and licenses, architect's fees, insurance premiums, temporary structures, property taxes, but you do not include organizational expenses or promotional expenses or any interest revenue on money borrowed here to construct or purchase the building. But what we're going to be looking at here is how should companies account for an old building that is on a site of a newly proposed building here. You bought the land here and you've got this old building on it, and then you're going to put up a new building, and would be for the removal of the old building. Does it go into the land account here, or does it get included in the building account? And we're going to look at a simple example here on this. Okay, now to our problem here. How should companies account for an old building that's on the site of a newly proposed building, and the new old building here has to be removed? So if a company purchases land with an old building on it, which has to be removed, then the cost of demolition less any salvage value here is the cost of getting the land ready for its intended use, and relates to the land here rather than to any new building here. So all the costs of getting an asset ready for its intended use are the cost of that asset here. Example, On April 1st here, land and building were purchased at a total cost here of $150,000, of which 20% here was allocated to the building, so 80% would have been allocated to the land. And on the company's books here, that's what recorded on the company's books. So the real estate was acquired with the intention of demolishing the building in order to construct a new building. The scrap value of the old building was $7,200. That would be the proceeds here that we got from demolishing the old building. So let's go and look at how we record that here. So the original purchase allocation of land, 80% here of the $150,000 cost, $120,000 gone to the land. Building would have been 20% of the $150,000, or $30,000 assigned to our building. So our total cost here is $150,000, which was allocated here between the land and building. And then we had a scrap value on the building here of $7,200. And we're going to find out that scrap reduces the land cost here. So on our original recording here, on our land account, we would have debited that here for $120,000. And then on our building account, it would have got debited here for $30,000. Now, the building here is demolished, so we would credit or eliminate our building account for the old building here of $30,000, and then the debit amount here would go to the land account. So in this case, we increased our land account here for the cost of that was allocated to the old building. And now we had some scrap value here from the demolishing this building here. That was, just say it was cash received on the scrap value of the old building. So we would credit or reduce our land account here by that $7,200 scrap amount here. So our total land account here would have been reduced again by the scrap account. The total land account here would be $142,800. And then for our scrap here, we would have, let's just say we received cash for it here. So we'd have debited or increased our cash account here by $7,200 for the scrap here value. Now let's go down and look at any gain or loss here on our income statement. Now we don't recognize any gain or loss here because what we've done here is we just transferred our old building costs into our land account here. So no gain or loss is recognized when you do that. So this is the key point here. When you're demolishing an old building and it would and you intended to build a new building, assign it to your land account here. And it wouldn't be a cost of, and just say we're going to put up a new building here. The new building wouldn't be a factor in here on demolishing the old building. It's strictly, the old building here strictly goes to the land cost, because that's what it costs here to get the land ready for use.